3 days. That is all it took. 3 days to erase 6 months of gains. 3 days to turn euphoria into despair. 3 days to remind everyone in this market that what goes up violently can come down even more violently. And as I record this, the bleeding has not stopped. It has gotten worse, because now we have a new player on the field. The CME just hiked margin requirements on precious metals futures. And that single decision has turned what was already a brutal sell-off into something that looks increasingly like a death spiral. Let me give you the numbers, because the numbers are staggering. Gold peaked at $5,594 on January 29th. As of this morning, it is trading around $4,700. That is nearly $1,000 erased in less than a week. $1,000 on gold. The asset that is supposed to be the safe haven, the asset that is supposed to protect you when everything else falls apart. Silver is even worse. It touched $121 last week, $121, and now it is struggling to hold 80. That is a 40% drawdown, 40% in days. This is not a correction. This is not profit taking. This is the kind of move that ends careers, wipes out accounts, and leaves people staring at screens in disbelief, wondering what just happened. And here is what makes this moment so dangerous. A lot of people think the worst is over. They see silver bouncing a few percent off its lows, and they think, okay, we found the bottom, time to buy the dip. But I need you to understand something. The mechanics that drove this crash are still in motion. The margin hikes that the CME just announced have not even fully taken effect yet. The feedback loop that is turning selling into more selling is still spinning. And the leverage that built up during the rally is still being unwound. So before you do anything, before you buy, before you sell, before you add to positions or cut them, you need to understand what is actually happening underneath the surface. That is what this video is about. Not hype, not panic, understanding. Let us start with the trigger that made Monday even worse than Friday. The CME, which is the exchange where most precious metals futures trade in the United States, announced on January 30th that they are hiking margin requirements on gold and silver contracts. Now, if you are new to this, let me explain what that means in plain language. Margin is essentially the deposit you need to hold a futures position. It is not the full value of the contract. It is a fraction of it, and that is what allows futures traders to use leverage. You can control a large amount of gold or silver with a relatively small amount of capital. When times are calm, that works beautifully. When times are volatile, it becomes a trap. What happens when the exchange hikes margin requirements is simple but brutal. Every trader who holds a position suddenly needs more cash in their account to maintain that position. If they do not have that extra cash, they have two choices: deposit more money immediately or liquidate positions to meet the new requirement. And here's the cruel irony. When you are forced to liquidate, you are selling into a falling market. You are adding to the selling pressure, which pushes prices lower, which triggers more margin calls on other traders, which forces more liquidations, which pushes prices even lower. This is the feedback loop. And once it starts, it can feed on itself until the leverage is completely flushed out of the system. One analyst I follow, Zane Vauda from Market Pulse, put it perfectly. He said the increase in margin requirements makes holding speculative positions less appealing now, and it forces a lot of retail traders who do not have extra liquidity to sell positions. He said it is creating a feedback loop where as prices drop, more traders face margin calls, leading to more selling and even lower prices. That is exactly what we are watching unfold in real time. Now here's the cliffhanger. The CME announced these margin hikes on January 30th, but they said the changes would take effect after market close on Monday. So what you saw on Monday, the early plunge where silver dropped 15% before recovering, where gold dropped nearly 10% before bouncing, that was the market front running the margin hikes. Traders were selling ahead of the deadline because they knew once those new requirements kicked in, the forced selling would intensify. And that means we might not have seen the worst of it yet, because the full impact of those margin hikes is still working its way through the system. Let me put this in perspective. Silver on Friday suffered its worst single-day percentage drop since March 1980. Let that sink in. 1980. That was 46 years ago. That was the Hunt Brothers collapse. And silver just matched that kind of historic devastation. A 31% drop in a single session. Every single person who bought silver on leverage in the last several months got absolutely destroyed. Every single person who thought they were smart buying the dip on Thursday got destroyed. Every single person who ignored the warning signs of a parabolic move got destroyed. This is not hyperbole. This is what the data shows. And here is what the mainstream coverage is not telling you. The stories coming out of China right now are absolutely wild. Bloomberg reported that Chinese metals traders are facing losses of at least 1 billion yuan, which is about $144 million, after a metals dealer named Xu Maohua, who is apparently known as the Hat, fled the country, leaving deals hanging. The report said among those doing business with him was a state-backed investment holding company. This has triggered China's state-owned regulator to order big commodities traders to review their operations. Think about what that means. A single dealer fleeing the country has triggered a regulatory response from the Chinese government. That tells you the scale of the carnage happening behind the scenes. But the story that really got to me was about a Chinese housewife. Bloomberg reported that she lost 700,000 yuan, roughly $100,000, after Friday's metals rout. And here's the detail that should make everyone pause. She had only opened her futures trading account on Monday, 5 days. She was in the market for 5 days. She saw silver going vertical, thought this is my chance, jumped in, and lost $100,000 before the week was over. That is not just sad. That is a warning about what happens when FOMO meets leverage meets parabolic markets. And I guarantee you she is not the only one with that story. She is just the one who talked to a reporter. Now I want to zoom out and talk about something that I think is crucial to understanding where we are. And this requires a bit of market structure education, so stay with me. There is a methodology called Wyckoff analysis that looks at how markets move through phases of accumulation, markup, distribution, and markdown. And what multiple analysts are now saying is that silver has clearly transitioned from the distribution phase into the markdown phase. Let me explain what that means. During the rally from around $40 to $120 over the past 6 months, a lot of new buyers came into the market. Retail traders saw the headlines. They saw silver breaking records. They saw the momentum and they wanted in. And while that was happening, the smart money, the institutional players who had built positions much lower, were quietly selling into that strength. That is distribution. They were distributing their long positions to eager new buyers who thought the rally would never end. The telltale sign was the false breakout above the previous high. In Wyckoff terminology, this is called a UTAD, an upthrust after distribution. Price spikes above a key level, everyone gets excited, more buyers pile in, and then the rug gets pulled. That is exactly what happened when silver touched 121 and then immediately reversed. The final buyers at the top were the last ones to arrive at a party that was already ending. And now we are in the markdown phase. The institutions have exited their longs and shifted to selling. Retail positions are being liquidated at massive scale. And the speed of the decline is precisely because there is nobody left to buy in size while everyone is trying to sell. Here is what that means practically. Even if silver attempts a technical bounce from oversold conditions, and we are definitely oversold, any recovery is likely to hit strong resistance in the $87 to $95 zone. That zone was where the selling intensified during the breakdown. It is where trapped buyers will be looking to exit at better prices, and it is where sellers will be defending their new short positions. So do not expect a V-shaped recovery where we just rocket back to the highs. That is almost certainly not going to happen. What is more likely is a period of volatile chop, lower highs, and ongoing distribution of whatever remaining long positions are stuck in the system. Now let me address the other side of this, because not everyone is panicking, and I think it is important to hear from the voices who are staying calm in the middle of this chaos. Deutsche Bank, one of the largest financial institutions in the world, came out on Monday and said they are sticking to their $6,000 gold target for year end. They raised that target just 2 days before gold's peak on Thursday, and they are not backing off. Their analyst Michael Sue said gold's thematic drivers remain positive, and they believe investors' rationale for gold allocations has not changed. He said the conditions do not appear primed for a sustained reversal in gold prices. Now you might be thinking, easy for them to say they are a giant bank sitting on unlimited capital, and that is fair. But here's what is interesting about their reasoning. They pointed specifically to China. They said China gold ETF holdings could see a new record in 2026. They said China has been a prominent driver of precious metals investment flows. And they said that suggests the rationale for a positive outlook has not changed. In other words, the long-term demand story that pushed gold and silver to these levels in the first place is still there. What is happening now is a mechanical unwinding of leverage, not a fundamental shift in why people want these metals. Barclays put out a similar note. They said they expect rate cuts, fiscal expansion, quantitative easing, fiat debasement, and de-dollarization to likely keep investment demand firm for gold. Notice the language. They are not saying buy the dip today. They are saying the factors that drove this rally are still in place. The market got ahead of itself. Leverage amplified both the up move and the down move, and now we are seeing the consequences. But the underlying story has not changed. Here's my take on that. I think they are right about the fundamentals, and I think they are right that this is primarily a leverage-driven event. But I also think we need to respect what the market is telling us right now. And what the market is telling us is that it does not care about fundamentals when deleveraging is in progress. When margin calls are going out and positions are being liquidated, the only thing that matters is liquidity. Where can I sell? Who will buy? And in that environment, price can go much further than logic suggests. That is why I keep saying do not try to catch falling knives, and do not assume the bottom is in just because things feel oversold. Let me walk you through what I am watching to determine whether the worst is over or whether there is more pain ahead. First, I am watching Shanghai. Ole Hansen from Saxo Bank made a point that I think is critical. He said the risk of second and third round selling remains elevated, particularly with Shanghai, which has been the main engine of recent support, showing sharp losses. What happened when Asian markets opened on Monday? Most commodity futures in Shanghai opened to sharp losses. That tells you the selling pressure is not just a New York problem, it is global. And as long as Shanghai is selling, the bleeding can continue. Second, I am watching physical premiums and dealer behavior. During the worst of the sell-off, some dealers reportedly widened their spreads dramatically or stopped buying altogether. If that continues, it tells you there is too much metal trying to find a home and not enough buyers. If spreads start to tighten and dealers start actively bidding again, that is a sign the physical market is finding a floor. Third, I'm watching the gold-silver ratio. Before this crash, silver was outperforming gold dramatically. The ratio had compressed. Now silver has fallen much harder than gold, so the ratio is widening again. If the ratio stabilizes and starts to compress, it could be an early sign that silver is finding buyers. If the ratio keeps widening, it means silver is still being treated as the higher risk asset that people want to dump first. Fourth, I am watching open interest in the futures market. Open interest is essentially the total number of outstanding contracts. When open interest collapses during a sell-off, it means positions are being closed out, which is what you would expect during forced liquidation. At some point, open interest will stabilize, which tells you the leverage flush is complete. We are not there yet. Fifth, I am watching the dollar. The dollar index jumped more than 1% on Friday after the Warsh nomination. A stronger dollar puts mechanical pressure on commodities priced in dollars. If the dollar continues to strengthen, that headwind persists. If the dollar move fades and reverses, that removes one source of pressure from metals. Now let me talk about the people who are hurting, because I know a lot of you watching this are in pain right now. And I want to be honest with you in a way that I think is more useful than just telling you everything will be fine. If you were over-leveraged, you probably already know the damage. Some of you got margin called, some of you got stopped out at the worst possible prices, some of you watched positions you built for months get liquidated in hours. That is brutal, and there is no way to sugarcoat it. The only thing I can tell you is that this is how you learn the lessons that textbooks cannot teach. Silver is one of the most volatile major assets in the world. It requires position sizing that accounts for 30, 40, even 50% drawdowns. If your position size could not survive that, then the position size was wrong, not the thesis. The position size. If you are holding physical metal, you are in a different situation. You do not have margin calls, you do not have expiration dates, you have metal. And metal does not go to zero, it does not expire, it just sits there. The price on your screen is lower than it was last week. That is real, but you have not lost anything unless you sell. The question for physical holders is whether the thesis has changed. And I would argue it has not. The industrial demand for silver has not changed. The solar installations have not stopped. The electronics manufacturers have not found a substitute. The supply deficits have not magically been solved. What changed is the paper market got way too crowded, way too leveraged, and way too one-sided. And now it is correcting violently. If you are sitting on cash wondering whether to buy, here is my honest advice. Do not try to be a hero. Do not try to call the exact bottom. The people who bought on Thursday thinking they were getting a deal are down 30%. The people who bought on Friday thinking that was the bottom are down another 10 to 15%. This market is not rewarding bravery right now. It is punishing it. Wait for stabilization. Wait for signs that the forced selling is exhausted. Wait for the feedback loop to break. And if that means you miss the first 10 or 20% of the recovery, that is fine. You will still have plenty of upside if the long-term thesis is correct, and you will not be another casualty of trying to catch a falling knife. Here is the scenario map I am working with right now. Scenario 1. The leverage flush completes within the next week or two. Prices stabilize at these levels or slightly lower. The physical market absorbs the shock, and we enter a consolidation phase before the next move, which could be up if the fundamental drivers reassert themselves. In this scenario, silver might trade in a range between 75 and 90 for a while before the next directional move. Scenario 2, the deleveraging continues and we get a more prolonged period of weakness. Shanghai keeps selling, the dollar keeps strengthening, and we see a deeper pullback that takes silver into the 60s or lower and gold toward 4,000. In this scenario, you want to be patient and not catch the knife. Let the market prove it has found a floor before committing capital. Scenario 3. This sell-off is followed by another surge in volatility in both directions. Whipsaws that trap both bulls and bears. Violent rallies followed by violent sell-offs as the market digests the change in positioning. In this scenario, cash is king and patience is more valuable than prediction. I am not going to tell you which scenario is most likely because I genuinely do not know. What I'm going to tell you is what would make me more confident in each one. For scenario 1, I need to see open interest stabilize, Shanghai stop selling, and physical premiums tighten. For scenario 2, I need to see the dollar continue to surge, the Fed narrative turn more hawkish, and no sign of physical buying stepping in. For scenario 3, I would expect high volatility readings, conflicting headlines, and a market that refuses to pick a direction. Now let me address a question I know many of you are asking. Is silver still a good investment? Is the thesis dead? Here's my honest answer. The thesis has not changed. What has changed is the price and the positioning. The industrial demand story is still there. The solar installations are still growing. The electrification of everything is still happening. The supply deficits are still accumulating. None of that got fixed because futures traders got liquidated. But the path matters. And the path just got a lot uglier. If you believed in silver at $100, you should believe in it more at $80. The fundamentals are the same. The price is lower, that is called a better value. But you also need to respect that the market is in liquidation mode right now, and liquidation mode does not care about fundamentals. It cares about survival. The question is not whether to believe in silver, the question is whether you can survive the volatility. Because if you cannot survive it, you will never get to be right. And that is the real lesson of the past 3 days. I want to close with a few direct questions for you. And I want you to answer honestly in the comments. Question 1. Did you see this crash coming? Be honest. Did you have any warning signs that the rally was getting too extended? Or did it catch you completely off guard? Question 2. What did you do during the crash? Did you panic sell? Did you hold? Did you add? Did you do nothing? There is no wrong answer here. I just want to understand how people are navigating this. Question 3. What would have to happen for you to buy silver aggressively again? What price? What signal? What change in the environment? I want to know what your conditions are. Your answers help me understand where the audience is, and they help other viewers who might be feeling alone in their decisions. So please take a minute to share. And look, if you navigated this well, if you had a plan and stuck to it, if you were properly sized and did not get liquidated, share that too. Not to brag, but to show others that it is possible to survive these moves, that it is possible to be positioned in this market without getting destroyed when volatility spikes. Before I go, let me say one more thing. Markets like this are designed to make you feel stupid. They are designed to make you feel like you cannot win, like the game is rigged against you. And in some ways it is. The institutions have better information, better technology, more capital, and longer time horizons than most retail traders. That is just reality. But here is what they do not have. They do not have your patience if you choose to exercise it. They do not have your ability to sit in physical metal with no margin calls and no expiration dates. They do not have your ability to dollar cost average over years without answering to quarterly performance metrics. The game is stacked against retail in the short term, but it is winnable in the long term if you understand the rules and play accordingly. Silver is still silver. It is still a critical industrial metal with monetary characteristics and a finite supply. The world is still electrifying. Grids are still being built. Solar is still expanding. And fiat currencies are still being debased over time. None of that changed because of a 3-day sell-off. What changed is a lot of over-leveraged speculators just got flushed out of the market. And that is actually healthy for the long-term structure of this trade, even though it is painful in the moment. Join our WhatsApp community if you want real-time updates and deeper discussions when moves like this happen. The link is in the description. Follow us on X, that is Twitter, for alerts and quick takes as the situation evolves. I am at Financial Crux, and I will keep covering this as long as you keep watching. This is not financial advice. I am not a licensed advisor. I do not know your situation. Nothing I say should be taken as a recommendation to buy or sell anything. Do your own research. Think for yourself. And never risk more than you can afford to lose. I will see you in the next one. Stay calm, stay focused. And remember, the market can be irrational longer than most people can stay solvent. Make sure you are not one of them.